Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go over some other Twitter articles or feeds that I think are important for everyone to listen to and to chew on. Chewing on it, I guess, this information. Well, we'll dive in here. It's about oil, uranium, and some metals. Everything that we talk about on the channel, this all pertains to all the commodities that we kind of look at. So I want to go over it. I want to show you some cool things that may change your perception on some things, and perhaps there's some misinformation out there. Everyone always says higher prices cures high prices, but the prices have to be high enough to actually dent the demand. So let's take a look at this. The first one I have up here is the Josh Young. It says, and now data for the full past week. Gas prices up, U.S. gas demand up 1%. Demand destruction, not yet. According to Gas Buddy data weekly, U.S. gasoline demand rose 1.1% compared to the previous week, the highest demand since the week of 12/12. So gasoline demand's going up. The scary thing is our inventories are going down at the same time that gas demand is going up, and that we are about to hit driving season, summer driving season at some point, where demand starts to go even higher. And what do you think everyone's going to do with a bunch of stimulus money who've been cooped up for a while? They want to get out, they want to drive, they want to travel, they want to do things that consume gas. I don't know if the price of oil or gas is high enough to stave off that demand. At least it hasn't been yet. Looking at Josh Young again, chart showing potential demand destruction price zone in this thread looks like multiple sources all pointing to $200 plus for that demand destruction. So we are not at high enough levels where demand is falling off. One, we can see it in the actual data. And two, there's a lot of people looking and crunching the numbers saying it's over $200 most likely. And it says, I've seen a couple of good charts on potential oil prices where demand destruction might kick in. They both imply much higher potential prices before demand destruction, which is consistent with my observation on Bloomberg last June. And then we've got U.S. Treasury Secretary Janet Yellen. I grabbed this one as well. It says, we're likely to see another year in which 12-month inflation numbers remain very uncomfortably high. Yeah, I thought this was transitory, Mrs. JY. Looking on the right-hand side, Marion Katusa, we're swapping to uranium. It says lots of upside left. Here's the first bull market, second bull market, third bull market. And what if this is one large move where this is a gigantic barrel pattern from the 1970s where you get two humps, and I've seen this before, and then you get a massive launch higher. To a completely different level. And that's kind of what I'm thinking it is with this next bull market that's coming in uranium due to the supply demand imbalances in a true shortage, not a liquidity driven event by a declining dollar during a real estate boom. This is a liquidity event on top of a deficit that's coming, a massive deficit. And this could be hump one, hump two, and then the big move. Looking at some other ones, this is oil stocks here. We're switching back and forth. It's a lot, mainly energy driven. SGY, which is Surge Energy, is a company that looks really good for free cash flow yield. If you look at free cash flow yield versus the enterprise value, then you look at 2023 free cash flow yield on this axis here. You want to be higher up here, and you want to be on the furthest to the left. The best that I have found at this moment is Surge Energy. Surge Energy is one that I am buying and cost averaging into myself. Moving on down here, we'll go with Eric Nuttall. It says, even if OPEC plus U.S. shale plus Iran plus Venezuela can offset most, if all, of Russian export losses, it means that we will have reached the most bullish event for oil in modern history. The exhaustion of OPEC spare capacity, no safety buffer with record low oil inventories. What do you think that's going to do to oil prices? higher. That's all I'm going to say is higher. Looking down at the top 10 holdings of his fund, ARC Resources, Baytex Energy, Synovus Energy, Enerplus, Headwater, Meg Energy, Nuvista, Pipestone Energy, Tamarack Valley, and Whitecap Resources, just to throw in there what he likes. This is also from him. It says, how many years of free cash flow at $100 strip natural gas price would it take for a company to buy back all of its outstanding shares and debt? Some of these are incredibly low. Surge Energy at 2.4, ERF at 2. Anything on this chart is probably pretty dang good. I'd say anything kind of below 4, you're looking at some pretty good numbers. I think we've got, let me see here, looking at these. This one's the ARC Resources, I believe. This is Meg Energy. These are all Canadian. Baytex, Crescent Point, Athabasca Oil. Coming down, this is the Surge Energy, Cardinal Energy. Looking over here, this is Deep Yellow Limited. This was done by Kevin with Bad Charts, North Star Bad Charts. Deep Yellow, we've got this bull pattern that's developing that I grabbed off Twitter. It's coming right down, and we've hit the bull twice. We've come on up, and it could come back and do kind of a sideways motion to hit that arc again. Maybe, maybe not. But it looks very good for a big long-term bull market in uranium. The patient investor will be rewarded. This is Deep Yellow here. We've got Mega Uranium here. He did another one that he posted. A couple of hits down here. We're coming on up. It could go sideways for a little bit and then move on again. He's got is an arc test coming where it kind of moves sideways, lower to sideways. I don't know. I don't try to get in the game of predictions. All I know is that the momentum's down, sideways, and now we're coming back up, and that's when I want to be invested. I've showed this before once. This is the crude gasoline distillate inventory deficit. It is massively going lower. We're eating through, and this deficit tied with what we talked about gasoline demand, that's not a very good combination for lower energy prices. It's going to be higher energy prices because we're eating through the inventory at the same time that demand is going up. So the price is not impacting the deficit, at least not yet. Coming on down here, we've got, this is Bad Charts, Patrick Karam. This is gold. I kind of shrunk it. It got a little bit crazy in the quality of the image. But we've broken out of this breakout confirmed of gold. And the next box, if you were to use this box and project it over here to the corner, is 7,700. My take is like 8,000 is kind of what I'm guessing. Each bull market's around 8 times, at least the last one. If it's closer to the other bull markets like the 1970s, we could see a much higher move than even this. I try not to get too caught up in the price projections, just that the projections are far higher than where we are today. So that's what I kind of look at. But we've broken out of this in terms of momentum. And I think it's going to look very good coming forward. So with gold having this momentum behind it and these projections being so high, we should see some problems. So I grabbed some more gold information. So it says, this is from Wall Street Silver. It says, the last time the Fed was this far behind the curve, it took them 9 years in hiking Fed funds rate to 22% to bring inflation back under control. And what they're doing is they're very far behind because we've got massively, very real negative interest rates. That's what this -6%, and I think it's even lower than that now. And the way that they had to bring it all back under control is to raise the Fed funds rate to a very high level to get it under control. Here's the core inflation, the red line. This is the real interest rate as it dove down to similar levels to where we are today in the 1970s. And they had to raise rates massively to get this all under control. I don't know if they can do that again. So what's coming here? It says the panic is now real now. All metals. It says the LME imposes a 15% limit on daily price moves across all metals. I wonder why they would do that. Interesting how this is coming out. Inflation is real, and they know what's coming, and they're going to try to limit this move, guys. I think something bad is coming, and the inflation is going to drive people to react to certain things differently. And once they figure this out, once they figure the inflation move and they can't put money in bonds, The most important thing to do is to watch interest rates. If interest rates really start to rocket higher, that's when you got to worry. That's when the money's starting to rotate and people are afraid of bonds and they're exiting bonds en masse, and you're going to have to get to investments before they do. Or you can sit like I am and just position in it already and just wait for this stuff. Elon Musk is even getting in this. Elon Musk says, own physical things when inflation is high, but he's not selling his crypto. At least that's what he says. Looking at this is some breaking news. U.S. Mint announces silver shortage. The United States Mint will not strike 2022 Morgan or Peace dollars, with Mint officials identifying silver planchet shortages as the reason for the cancellation of the planned coins. Silver shortages. Who would have thought that? Finding Value did. Okay. Yeah, he did. So that's what I've got for today. I don't think I've missed anything on this chart here. So that's what I've got for today, guys. I just wanted to go over all that information that I've been seeing. I'm again a huge proponent of physical metals. If they're going to start limit up on daily price moves, and if we're in an energy shortage, I think the physical metals, energy companies, good mix altogether. Some royalty companies thrown in, maybe some mining companies thrown in the mix. I do think that's a pretty good, solid portfolio. If you want to venture out and do some other things, that's up to you. I've got a couple of other investments like in healthcare and stuff, but it's not really a huge stake that I own, so it's nothing really to talk about. But that's what I've got for today, guys. And I know we had a large down day yesterday, which is today because I'm doing this at night, kind of. But don't be afraid, guys. This is what's coming. This is the data. So this is more data backing the thesis, along with the charts that we read, along with the fundamentals that we're seeing, the market balances, the inventory drawdowns, and all those things. So just be patient and get your shares when they're cheap. I know it feels weird to buy when things are down. Some people don't have a problem. I don't, but there's others that do. That's how you make more money. You buy it when they're down. Is it going to be a bottom yet? I don't know yet. We'll have to wait and see. We'll have to see what the momentum does. We had a pretty large sell-off day. Momentum's quite strong to the downside, so I usually like to wait for that to dissipate first, and then I pick up some shares. Not that I'm going to be picking up a large amount. More than likely, it's just a constant drip in over time. Give me a thumb up for the content. Subscribe to the channel if you haven't already. Check out my new website. The link's below in the description field. It's www.finding-value.com. You do have to sign up. Silver membership gets you the education. Platinum membership gets you the education and stock picks and charting of individual companies and all that. Thank you for listening. This is Finding Value.